12 Habits of Successful Stock Investors. Investing in stocks is an excellent way to grow wealth. For long-term investors, stocks are a good investment even during periods of the market volatility. A stock market downturn simply means that many stocks are on sale. If you've never invested in the stock market before, it can be an intimidating process. Stocks are not like savings accounts, money market funds, or certificates of deposit, in that their principal value can both rise and fall. Welcome to Alpha Galore, the place for those in passionate pursuit of luxury and wealth. Smash the subscribe button now and hit the notification bell to be notified when new videos are released. The stock market can be risky, and if you don't want to lose your money, here are some important tips you need to know. We asked successful stock investors to tell us about their habits that made them rich. Here are 12 habits of successful stock investors. Number 1. Only let winners run. What is more important is to let a winning trade run and get out of a losing trade quickly. If you follow this rule, the money you make on the winning trades will far outpace the losing trades. Dennis Gartman, a successful stock investor, says, "Be patient with winning trades. Be enormously impatient with losing trades." One of the most common mistakes young investors make is recognizing the losing and winning trade and then doing what needs to be done. First, don't sell at the first sign of profits. Let winning trades run. Second, don't let a losing trade get away. Investors who make money in the markets are okay with losing a little bit of money on a trade, but they're not okay with losing a lot of money. Number 2. Design a goal and strategy. Setting goals helps trigger new behaviors, helps guide your focus, and helps you sustain that momentum in life. If you go on making investment decisions without a specific outcome in mind, you might not be able to get anywhere because you never had a fixed goal in mind. Successful people always make goals and they know exactly what they want to achieve. The next step is strategizing for achieving the goal. Strategic planning is important to an organization because it provides a sense of direction and outlines measurable goals. There are highly personal questions that each investor needs to answer for themselves to know what they want to achieve in life. There's no right answer, just the correct answer for your life and goals. Number 3. Set money aside. Before you put any of your money at risk, you should first have some put away that will not be subject to any risk whatsoever. You never know when you get into an accident, an appliance stops working, you lose your job, or get medical bills. For such unexpected events in life, you should always stay ready mentally and financially. No one wants to go through the embarrassment of asking for money from friends and family even if they can pay it back. After you get rid of debt, you should immediately set up an emergency fund. In your savings account, hold an amount at all times that you can only use during hardships. You might also be able to get a trickle of interest on your savings. Number 4. Diversification is for sissies. A universal rule that most young investors know is diversification. That says don't put all of your investing capital into one name. Diversification is a good rule of thumb, but it can also diminish your profits when one of your picks makes a big move while other names don't. Making money in the market is also about taking chances based on exhaustive research. Always keep some cash in your account for those opportunities that need a little more capital, and don't be afraid to act when you believe that your research is pointing to a real winner. Number 5. Think long term. The main reason to buy and hold stocks over the long term is that long-term investments almost always outperform the market when investors try and time their investments. Just like Warren Buffett says, our favorite holding period is forever. You can gain immense returns if you are willing to hold stocks for a long time. Generally, it is better to hold stocks for the long term, meaning at least a few months and preferably a decent amount of years. Holding stocks for shorter periods will essentially increase your risk of turning a temporary loss into a permanent one. Number 6. Wariness. Investors don't choose a stock because it is going up or they received advice from someone to buy it. They calculate everything. Even if they choose a risky investment, they make informed decisions. They know exactly what they are getting into. Many people have made and lost thousands of dollars overnight when they invested in bonds and stocks. Investing in corporate bonds with the right knowledge will help you build wealth soon. If you want to step up your investing game and are all about getting rich, investing in the stock market is the best option. There is only one piece of advice to act upon. Use your exhaustive research based on facts, not opinions obtained from trusted sources. Other advice can be considered and verified, but it shouldn't be the sole reason to commit money. Number 7. Look for opportunities. This one is the best habit of successful investors that have helped them build huge empires. We are part of the community that said it's always the end of the world. In the times when people say it's the end of the world, the ones that have cash, no fear, and willingness to invest it. That's why it's so important to have cash set aside. When everyone in the market is fearful, you have to be greedy and buy stocks at the lowest prices to benefit from them in the coming years when things go back to normal. Number 8. Staying patient. Whenever the market is under pressure and everyone is selling stocks at a going price, that is when you don't have to sell them. Patience is the key here. Most stock investors who have outperformed others exhibit this trend of holding stocks whenever others are ready to sell. Investors that have strong convictions and have done the research can hold for long periods, riding out rocky market events. When 90% of the investors sell stocks, you have to be among the 10% who don't. Building wealth is a piece of cake when you understand the rhythm to make investments. Number 9. Always look ahead. Successful stock investors are always forward-thinking. They don't look at what's happening now. Instead, by studying the momentum of a company or an entire economy and how it interacts with its competitors, they invest now for what will happen later. They try to find the next big winner, but always anchor their portfolio with great companies that have a long track record of steady growth. They are never too quick nor too slow to make decisions. As we mentioned earlier, they calculate everything. Number 10. Don't listen to others. Successful investors don't let others stop them from creating their own business identity and investing in the stock market afterward, sticking to it at all costs. They write their own story even if they listen to others. They do what they want to do and are determined to do. How many times in your investing past have you read an article, watched a news report, or took a tip from a trusted friend about the next hot stock and lost money? Successful investors don't take advice from people who over-withdraw their credit cards and barely make ends meet every month and talk about getting rich all day. They don't even do exactly what another rich person does. They sing their own song. Number 11. Do your homework. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, says Warren Buffett. Warren Buffett is widely considered to be the most successful investor in history. Not only is he one of the richest men in the world, when Buffett talks, world markets move based on his words. Buffett gives 2 key pieces of advice when evaluating a company. First, look at the quality of the company, then at the price. Looking at the quality of a company requires that you read financial statements, listen to conference calls, and vet management. Then, only after you have confidence in the quality of the company, should the price be evaluated. He also noted, if a company isn't a quality company, don't buy it just because the price is low. Bargain bin companies often produce bargain bin results. Number 12. Take one step at a time. You need to gain immense knowledge if you want to invest in stocks like a pro. If you are a beginner, you have to be careful where you set your foot in the stock market. Move towards your goal gradually. Learn about a certain company or stock, one at a time. Invest in it and then move forward. Yes, Diversification is for sissies, but when you're starting, take a minimal position in one stock, generally 100 shares, to take advantage of the best pricing and then move into another stock. Once you have made several investments in mutual funds and ETF, you can begin investing in stocks one at a time as you work toward building a portfolio. Thank you for watching this video. Which other successful habits did I not mention in this video? Let me know your thoughts by leaving it in the comments below. If you enjoyed this video, please smash the like button and subscribe to our channel to see more videos like this on a regular basis.